Hello again from me, Rossouw. I'm a portfolio manager at Adviceworx Private Client Securities, and I'd like to spend the next quarter of an hour sharing some ideas with you. I will discuss the COVID-19 pandemic and its impact on the global economy and investment markets. I will also explain how Adviceworx interprets the current investment climate and share our views on prospects for the short to medium-term future. November saw the COP26 climate change summit take place in Glasgow, Scotland. Amidst all the concern and sensation around COVID-19, this cartoon by The Economist is a timely reminder that whilst COVID is a temporary phenomenon, climate change is something that is here to stay. And unless we do something meaningful about it, it's going to affect the future of our children and our children's children. As of the 30th of November, 262 million people had been infected with COVID-19 worldwide, and more than 5.25 million people had succumbed to the disease. The United States remains hardest hit, with 49.1 million infections and more than 799,000 fatalities. India, Brazil, Britain and Russia still make up the rest of the top 5, and South Africa remains in 18th position worldwide in terms of the most recorded cases. New COVID cases kept rising in November, and the new Omicron variant has been identified as a variant of concern. Britain and Central and Eastern Europe remain the epicenter of the pandemic, and it is now received wisdom that vaccinated people can and do contract and spread the Delta variant. To date, over half the world's population has received at least one dose of vaccine, and an estimated 43% of the world's population can now be deemed to be fully vaccinated. More than 1 billion of them are Chinese. Only 5.7% of people in low-income countries, however, have received at least one dose to date, and the daily vaccination rate is once again rising from nearly 23 million per day in October to 27 million per day in November. This infographic clearly depicts the disparities in access to vaccination between rich and poor countries. On the left, we can see that more people in rich countries have received a third or booster shot of vaccine than have received any form of vaccination in poor countries. On the right-hand side, we can see that about 80% of people in rich countries have received some kind of vaccination, about 75% in upper middle income countries, around 50% in lower middle income countries, and less than 6% in low-income countries. Supply chain constraints continue to weigh on economic growth while contributing to inflation. In America, growth seems to be plateauing while inflation is still rising. Eurozone growth looks okay, but inflation is a concern there as well. The US Federal Reserve has meanwhile admitted that inflation may not be so transient after all, and in China, GDP growth is slowing from its lofty levels of a few years ago. Inflation, meanwhile, is rising sharply. Emerging market central banks have generally started hiking interest rates. There is concern about the fact that oil and coal prices have risen sharply this year despite all the pledges to move towards a greener economy, and there is still a labor market skills mismatch. There are many unemployed people, but even more unfilled jobs. After a sharp worldwide contraction last year, GDP growth in most countries looks set to be robust this year. For 2022, the prospects look less exciting, with many of the world's major economies set for slower growth than this year. The notable exception is India, which is expected to grow by 8.5% next year. South Africa, unfortunately, is predicted to only enjoy GDP growth of 2.2% in 2022. After rising precipitously during the second and third quarters of this year, energy prices have started to come down of late. The prices of oil, natural gas, and coal look set to continue softening over the coming months due to a combination of slower economic growth, a stronger US dollar, and increased output. Thanks to the fourth industrial revolution, semiconductor microchips have become ubiquitous in our daily lives. Most of the machines, appliances, and vehicles that we rely on include microchips to some extent. One of the biggest constraints on global economic growth in the coming months and years is the continued shortage of microchips thanks to production problems in especially Taiwan and South Korea. In recent years, it's been the norm for manufacturers to wait roughly 2 to 3 months between ordering microchips and receiving them. Since the beginning of 2021, the waiting period has risen to a record 21.7 weeks, that is between 5 and 6 months. After a generally strong month, global equity markets were rattled towards the end of November by the emergence of the Omicron variant of COVID. Chinese stock exchanges remain under pressure as there are no signs of government letting up on its crackdown on big tech companies. Global bond yields continue to rise as inflation concerns worsen. The Bloomberg Global Bond Index looks set for an annus horribilis. The rise in US bond yields has seen the US dollar appreciate against most currencies, and this has resulted in lower commodity prices. Shipping backlogs have become such a headache that many logistics companies are now chartering aeroplanes to transport their wares. Many global stock market indices were pulled down by the emergence of the Omicron variant, and many of them ended the month in the red. South Africa's top 40 index was the best performing major global index in November, and the Hang Seng in Hong Kong the worst. For the year to date, the CAC 40 in Paris remains in pole position, with the Hang Seng once again bringing up the rear. Over a one-year period, the Sensex in Mumbai was the best performing major index, with the Hang Seng the worst. Over 3 years, the Nasdaq remains firmly at the head of the pack, and the Hang Seng brings up the rear. This graph shows clearly just how dismally Chinese equities have performed this year. The MSCI United States Index is up by more than 20% for the year to date, and the MSCI World Index, 50% of which consists of US equities, is up by about 18%. The MSCI Emerging Market Index, of which China makes up a sizable portion, is barely positive for the year, while the MSCI China Index is down by more than 10% since the 1st of January. November was a poor month on global commodity markets, with the notable exceptions of coal and uranium prices, as well as those of the battery metals, nickel, lithium, and cobalt. Brent crude oil suffered a major reverse, while the cobalt price rose by nearly 12%. For the year to date, iron ore is the worst performing commodity at minus 39.2%, while the price of lithium has skyrocketed by nearly 327%. Looking ahead, we expect global economic growth to moderate next year, largely due to a combination of inflation and supply chain disruptions. Global equity markets will probably not perform as well as they've done this year because monetary conditions will be tighter and valuations are now looking stretched. With tighter monetary policy, volatility should increase. The two major downside risks remain inflation in the United States and/or a slump in China. The Eurozone is expected to remain in a purple patch thanks to easier monetary policy and more modest equity valuations. The commodity boom is mainly over, but it's unlikely that commodity prices will collapse in a heap. From an emerging market perspective, a stronger US dollar is a mixed blessing. On the one hand, it causes capital to flow towards the US, but on the other hand, it cushions the impact of lower commodity prices. There has been widespread and understandable outrage in South Africa at British Prime Minister Boris Johnson's knee-jerk reaction to the announcement that South African scientists had identified the Omicron COVID variant. Without waiting for all the facts to emerge, Johnson immediately instituted a ban on flights and travel between South Africa and the UK. As of the end of November, nearly 3 million South Africans had tested positive for COVID-19 and just under 90,000 people had succumbed to the virus. The daily death toll is rising, and there is consensus that the fourth COVID wave seems to be upon us. Early indications are that the Omicron variant is probably more contagious than its predecessors, but it is still unclear whether it causes more severe symptoms and whether it is vaccine resistant. 3/4 of recent new cases and hospitalizations were reported in Gauteng. Meanwhile, nearly 26 million doses of vaccine have thus far been administered. Unemployment in South Africa reached a new high of 35% according to the official definition and 47% according to the expanded definition during the third quarter of 2021. CPI was thankfully unchanged, even though fuel and electricity costs continued rising. Core inflation remains steady at 3.2% because services inflation continues to be subdued. As expected, the Monetary Policy Committee hiked the repo rate by 0.25% in November, even though the decision was a split one. South African GDP growth is expected to slow to 2% next year, and mining and manufacturing output remain below pre-pandemic levels. We had to endure another round of load shedding in November, and in some quarters the outages were blamed on sabotage. Meanwhile, the petrol price keeps rising and motorists are now forking out 40% more per litre than 12 months ago. One of the most concerning takeaways from November's Monetary Policy Committee meeting was the prospect of South Africa having to endure stagflation over the coming years. Put simply, stagflation means that the economy doesn't grow, in other words, it stagnates, while inflation remains elevated. The Reserve Bank predicts that GDP growth is likely to drop to below 2% next year, while inflation will remain above 4%. In 2023, the growth number stays the same while there's a slight uptick in inflation, and in 2024, at 2% growth will remain subdued while inflation will remain elevated at above 4%. A budget deficit typically consists of two elements: the so-called primary deficit, which is the shortfall between expected expenditure and expected revenue, and interest payments, which is the cost of servicing the existing debt burden. In his medium-term budget speech, the Minister of Finance expressed confidence that government would manage to lower the size of the primary deficit over the coming years. But the bad news is that the interest payment burden is likely to continue rising and will reach around 5% of GDP by 2023-24. The extent of South Africa's summer rainfall is generally determined by whether there is an El Niño or La Niña effect over the Pacific Ocean. When temperatures are above average, an El Niño event occurs which results in below average rainfall in our summer rainfall region, whereas a La Niña results in above average rainfall. The good news for South African farmers is that there is a well-developed La Niña effect underway, and that should see us enjoy good summer rainfall this year. The JSE All-Share Index breached the 71,000 level for the first time this month and ended the month up 4.5%, with strong performances from the industrial and resources indices. Financials, however, were sharply down. Resources and rand hedge stocks benefited from a weaker rand as the local currency depreciated by 3.5% against the surging US dollar. Bond yields followed their global counterparts weaker, and Discovery has announced that 95% of its staff is now vaccinated against COVID. Aspen, meanwhile, has secured the right to manufacture Johnson & Johnson vaccines under license for the African market, and there has been widespread resistance and condemnation of Shell's plans to explore for oil along the Wild Coast. 2021 has been an eventful year on the JSE. The top 40 index has returned a respectable 19% for the year to date, but within the broader index, individual stocks have produced widely divergent returns. November saw Richemont up more than 22% on the back of a weaker rand, while Old Mutual lost nearly 10.5%. BHP and MTN also had strong months. For the year to date, MTN and Sasol are the diamonds and Naspers and Prosus the dogs, as was the case over 1 year. Over 3 years, Sibanye-Stillwater leads the pack, with Old Mutual bringing up the rear. This Smarty Box infographic depicts how the main asset classes have performed over the preceding 12 months in recent years, measured at the end of September. On the right-hand side, we see 5, 10 and 15-year returns as at 30 September 2021. Interesting features of the past year include that listed property has gone from 0 to hero, that local equity beat foreign equity for the first time in 6 years, and bonds for the first time in 4, and that local cash yielded a negative real return. In other words, less than inflation. Over the long term, foreign and local equity remain the best performers. Looking ahead to next year, we expect the local economy to lose momentum and for investment returns to be more muted than this year. The key headwinds facing us are tighter monetary policy, slowing global economic growth, and a weaker balance of payments. Equities are expected to deliver decent returns, but significantly less than this year's. Given this outlook, we favor quality businesses that consistently pay decent dividends. We also prefer rand hedges like Richemont over resource producers. Bond yields remain attractive in real terms, but next year's budget needs to reassure investors. Thank you for your time and interest. We certainly live in interesting times, and I hope that this presentation will help you make sense of it all. Should you have any questions or queries, please feel free to contact me or your Adviceworx financial advisor. This is my last presentation for this year, so I'd like to use this opportunity to wish you and your loved ones a happy and safe festive season and a prosperous new year.